Hello, my dear student. Today we are going to consider board paper 2016 and 17. The last class we completed board paper 2015. Directly we'll enter in our board paper. Let's see which type of problem came on that particular year, that is 2016. Here in this problem there are three partners, that is old partner and one new partner, means altogether four partners problem. So this is the problem here. L, M, N are partner in the profit sharing ratio 3:2:1. That is 3 by 6, 2 by 6 and 1 by 6 of L, M and N. The balance sheet as on 31st March 2015 was as below. And this is their balance sheet. Balance sheet is same as like other year problem. All are common terms. Like bank balance this time provided 34,000, debtors balance 46,000, that is a gross debtors balance 46,000, stock 2,20,000, investment 60,000, furniture 20,000, machinery 70,000, sum total of asset side 4,50,000. Bank debtors and stock, these three are current asset, and here these three are non-current asset. Now here on the liability side, creditors 1,68,000, general reserve, that is undistributed profit, as well as internal liability 42,000, and creditors 1,68,000, that is outsider liability, current liabilities. Now three partners capital, like L capital 1,20,000, M capital 80,000, N capital 40,000. Altogether 2,40,000, the total capital of the old partners. Now on the date, new partner O is a new partner, want to take admission, and other term and condition are as below. Number one, their new ratio, like L, M, N and O, the new ratio is 2:1:1, means 2 by 6 of L, 2 by 6 of M, 1 by 6 of N and 1 by 6 of O. That is new partners here indirectly provided 1 by 6. Other problem generally we see that when new partner enter, that time he acquire 1/3, 1/4, 1/5, like that type of share it is mentioned. But in this question here, directly that way not mentioned. From here we have to understand that it is the new partners share profit sharing ratio, like it is last one, that is 1 by 6, 2, 2, 1, 1. So 1 by 6 it is our share of profit. So when he enter, that time his share will be given 1/6. Now other term and condition, like on the date of admission, the agreed value of the goodwill 1,80,000, that is enter firm goodwill. And O as a new partner, he will bring his share of goodwill money in cash, so that is entire firm. Thereupon 1/6, that is 1/6 means 30,000 amount of goodwill which have to pay by the incoming partner. And you know, when a new partner able to pay share of goodwill money, will apply premium method. Under the premium method, there are two journal entries are there, like first journal entry, bank account debit to PGW, and second, that is PGW means premium for goodwill account debit to old partners capital account under sacrificing ratio. Here the amount of goodwill not withdrawn, so therefore withdrawn entry is not required. Elimination entry also not required. Here in the old balance sheet no goodwill is there, so here only two entries are required, that is one for goodwill money brought, another for transfer of benefit to the sacrificing partner. So this is all about, that is adjustment number 2. Now another way, the market value of investment was rupees 36,000. So here market value of investment 36,000 came, and the old value 60,000. So that is book value, it was 60,000, and market value decreases to 36,000. So it is a bad investment. We can say that asset value decreases. So we know as per rule we have to show the entry, that is revaluation account debit to investment account, difference amount, that is 60 minus 36, 24,000 value decreases. So that entry we know like revaluation to investment account. Now another way, machinery also will be reduced to rupees 58,000. Here machinery revalued like market value came down 58,000. Earlier value it was 70,000. So maybe machinery use like more uses is there, so therefore it is more depreciation is there. 58,000 revalued figure. So machine value decreases and it will be same. Asset value decrease and there is revaluation account debit to machine account, difference amount. A creditors of rupees 6,000 was not likely to be claimed, hence to be write off. So here several times this type of information we got. It is a benefit to the business. Every business entity always want when they will buy the material and no need to pay the amount to the supplier. So that type of benefit all the business entity wants. So it is a benefit to the business, and ultimately liability decreases. So decrease of liability, we know the entry when liability decrease, liability account debit to revaluation account. So creditor account debit to revaluation account 6,000, 6,000. Now new partners will bring proportionate capital so as to give him 1/6 share of profit of the firm. This is also same last instruction part, that incoming partner's capital is missing, hidden, and he will bring proportionate capital of the new firm, that is 1/6 his share. So you can find out the capital of the combined capital, thereupon we can multiply into 1/5. So we can find out the incoming partner's capital. It is 1/6, so it will be 1/5. If it is 1/4, it is 1/3. Like that way you can find out, or you can use the unitary method. That way also you can find out. So let's see the solution here. First of all, revaluation by creditor, decrease of liability 6,000, decrease of asset investment decrease 24,000, machine also decreases. Here the revaluation 36,000 and credit side only 6,000. So therefore loss arises, 30,000 loss arises at the time of admission of a new partner. These are the changes take places, assets and liabilities. So here ultimately loss arises, and the loss we have to distribute to the old partners in their old ratio. The old partner here L, M and N, and their old ratio it was 3:2:1. Old ratio it is provided 3:2:1. So on that ratio it was distributed, and amount came L amount like share of loss of revaluation 15,000, M 10,000, N 5,000 as per their old ratio share of loss on revaluation which was being transferred. Now we'll come to the next accounting step, that is opening partners capital account. As it is like we will apply the columnar method, as there are 4 partners. So for old partners we'll use the columnar method, and for new partners separately we'll open. So as it is old partners, like opening balance L amount 1,20,000, M 80,000 and N 40,000. Once we can check that balance from the old balance sheet. Yes, 1,20,000, 80,000, 40,000. That is going on partners capital buy side. Liability side, all the item like which will come on partners capital, that will goes to the buy side. If any asset side item comes, like that time it will go like 2 sides. Suppose goodwill is provided on the asset side, that time you have to take 2 sides for elimination of goodwill. So here this opening capital will write buy side. General reserve also it come on the buy side. For closing general reserve, cancel of general reserve account debit to partners capital account. So here also general ledger, POI general ledger under old ratio 3:2:1, total 42,000. So L's here 21, M 14, and N 7,000. Now here buy premium account, that is premium for goodwill, actually 30,000. How it came 30,000? So here we know when new ratio and old ratio separately provided, first it is better to calculate sacrificing ratio, because that old may not come again sacrificing, it can change. So that thing happened here, because we can see here old partner, all the partner are not sacrificing here, only L, that is first partner, I think here sacrifices. Let's check the working here. Here is the working or calculation of sacrificing ratio. Sacrificing ratio formula, old ratio minus new ratio, that is the sacrifice of L over 3/6 and N are 2/6. So it is coming 1/6. M, that is old 2/6, new also 2/6, so it is unchanged. N also same, old 1/6 and new also 1/6, so remain unchanged. Therefore only one partner has sacrifices, that is first partner L. So the total premium money will credit to only L. Therefore this entry is first here, that is buy premium or goodwill, that is 30,000 we credited to L column only. Now revaluation loss arises. So here we write it to revaluation and share of loss to old partners under old ratio L, M, N. We already got from here 15, 10 and 5. So therefore here 15, 10 and 5 we distributed. After that we can find adjusted capital, like combined capital calculation of new partners capital, combined capital required of the old partner, adjusted capital. So just we can find out two balance CD. Credit of L 1,71,000 minus 15 1,56,000, exactly M 84,000. Current balance came, N 42,000 came. So that is their present balance. Now we can find out that is incoming partners proportionate capital, that is O's capital, how it came 56,400. We'll check the working here. This is the working. Combined capital here 1,56,000, 84, 42, 2,82,000. So 2,82,000 total combined capital of the old partners. So like 1/6 will get by the new partner. So 1 minus 1/6, that is 5/6, 5/6, that is old partner. So 5/6 purposes 2,82,000. So what will be one purposes now? 2,82,000 into 6/5, and what will be then 1/6, then into 1/6. So ultimately 6 cancel. It is, we are getting here 1/5. So therefore I told there, after finding the total adjusted capital, we can divide it, only divided 5 will get the new partner's capital. Here it is the new partner's capital 56,400. So there are so many ways. Which method is easy? That way you can find out. Adjusted capital calculation also here it is shown, that credit side 1,20,000 plus 21 plus 30 and debit side minus revaluation loss. So like that way adjusted capital also we calculated here. And if you don't calculate here, we are getting from that partner's capital only here. Partner's capital 1,56,000 plus 84 plus 42. It is coming 2,82,000. 2,82,000 thereupon into 1/6 into 6/5 using unitary method. We have done already that type of problem, and we already calculated the incoming partner's capital when it was missing. So that is nothing new. Everyone knows that again it is repeated. So therefore here new partner's capital, here it came like 56,400. So bank account debit to O's capital, therefore Y bank 56,400 to balance sheet 56,400. Like that way we can find out. Now the new balance sheet, the four partners here, new balance sheet, partners capital L, M, N, O. That the capital here we are getting from partners capital account to balance CD there 1,56,000, 84, 42. as well as 56,400. The same amount here we recorded 1,56,000, 84, 42,000, 56,000 and 400, total coming 3,38,400, and KTAS it is coming here 1,62,000. because here KTAS some like KTAS 6,000 amount of need to pay here. Why KTAS 6,000 decreases? Earlier value of KTAS it was 1,68,000, so 6,000 if we deduct it is coming here 1,62,000 KTAS. Now revalue figure of machine 58,000, furniture 20,000, investment revalue figure 36,000, stock here 2,20,000, debtors 46,000, it was remain unchanged. Cash balances, opening balance of cash 34,000, and incoming partners goodwill money 30,000 which he brought, and his capital 56,400. Total cash balance coming 1,20,400. So now afterward, if you add asset equals to liability as well as capital, both the sides are same. So like that way that solution same way, balance sheet it is required to keep here like partner revaluation account, partner's capital account and balance sheet. So that is the last step of the sum. Now we'll enter the next year problem, board paper 2017. It is also easy problem, but main difference is there. In this problem instruction part only pass necessary journal entry for all these transactions. In this case is no ledger required, like we cannot open revaluation ledger, we cannot open partners capital, and also balance sheet also not required. So therefore you can say this year problem quite easy for the 2017. Directly we are entering the problem. C and D are partner in the ratio 4:1, that is their old ratio 4/5 and 1/5. They admitted E as a new partner for 1/4 year. So share of profit provided here in this question, that is incoming partner share of profit 1/4. On the date of admission, the financial position of C and D were as below. All are known term: cash balance 24,000, debtors 36,000, stock 40,000, furniture 80,000, plant and machinery 80,000, their capital 1,20,000, debtors D's capital 80,000, provision for doubtful debt 4,000. So here we already seen that sometime provision for doubtful debt it is provided on the liability side as a current liability without deducting from the debtors. That is also one way. The gross value we can take this side, and here like deduction amount we can put on the liability side. Side change, this side it is a minus, so this side automatically it will come as a plus. So provision for doubtful debt it is 4,000. Another way can be shown here: debtors in column 36 less provision for doubtful debt 4,000. So debtors net value it will be coming here 36 minus 4, 32. That way also we can show, but here it is given in that way. Balance sheet nothing new, we already did that problem. Next term, creditors 40,000, outside liability. General ledger also provided 10,000, outstanding salary also provided 6,000. So total of the liability side 2,06,000, total of the asset 2,06,000. Now on E admission, when the new partner E take admission, they are the like adjustment we have to make. For the adjustment, now E new partner has to pay 1 lakh as his capital and 20,000 for his share of goodwill money, and half of the amount withdrawn by the old partner, that is C and D. So this is the like information related to primary information. Cash account or bank account debit to is capital account, first entry, that is capital contribution related. And for goodwill purposes, here 3 entry will be there: bank account debit to PGW, again PGW account debit to old partner's capital. For transfer and withdraw purposes, like we have to pass the entry, that is old partner's capital account debit to cash or bank account. So like that way you can pass the entry. Now number 2, rupees 2,000 written up as a bad debt. So it is a new bad debt, and 4% provision you have to maintain on the debtors for doubtful debt. So here there are 2-3 way we can do here. Like first thing, like normal way, if you think rupees 2,000 as a bad debt, we know the entry for bad debt account debit to debtors, that is like bad debt creating entry. Now we have to close that bad debt. Profit and loss account debit to bad debt, profit and loss adjustment, it is better to say. that is called revaluation account debit to bad debt. So ultimately we can say revaluation account debit to bad debt or to debtors. So that 2000 purposes, that entry we can make here revaluation account debit or profit and loss adjustment account debit to bad debt or debtors, both we can write here. So ultimately debtors value here 2000 decreases. After decreasing 2000 value from the debtors, like debtors amount here 36,000. So 2000 if you deduct, it is coming here 34,000. So 34,000, thereupon 4% you have to calculate as a provision for doubtful debt. So if you calculate 4% on thereupon 34,000 in the amounts here in working, you will show here this thing I have shown here in the working. I will calculate here like here 36 minus 2, thereupon 4%, it is coming 13600. So that is new provision for bad debt. So new provision for bad and doubtful debt. So that purpose the revaluation account debit to provision for bad and doubtful debt account, and old provision cancel purposes we can pass the entry, that is old provision account debit to revaluation account. So ultimately this term is like little bit new term, and once I'll repeat it, that is for 2000 bad debt purposes, like revaluation account debit to debtors account or to bad debt account, number 1. Number 2, creation of new provision for bad debt, revaluation account debit to provision for bad debt account. 4%, like 4% you have to calculate after deducting 2000 from debtors, that is 34,000. Thereupon 4%, it is coming 1360 rupees. Now already old provision is there, that you have to cancel here. For cancellation of old provision for bad debt account debit to revaluation. Or another way you can show the net adjustment here. Another way you can say the adjustment. So here this is one method I told. Another method you can use here, like first of all this 2000, like bad debt when arises, first entry bad debt account debit to debtors. Now as we have already provision 4000, we can utilize this provision. Sufficient provision is there, provision for doubtful debt. So bad debt we can transfer in this provision. So second entry you can write provision for bad debt account debit to bad debt 2000, and after that we can create provision for doubtful debt. So when you create the provision for doubtful debt, new provision and old provision will compare. If the new provision is more, then we have to pass this entry like provision for bad debt account debit to revaluation. So we will see the solution, it will be clear again. Now after that, next adjustment, stock reduced by 2000, furniture by 4000, and 10% depreciation charge on the plant. So these are all asset value decreases. So revaluation account debit to respective asset and respective amount. Investment amount will be 7000, not shown, it is unrecorded asset. So investment account debit to revaluation account. A provision was to be made for outstanding bill for repairs, which is 2300. There is also unrecorded liability, revaluation account debit to outstanding repair bill. Now one by one we'll consider. First one, like adjustment 1, journal entry, cash or bank account debit. Yes, bank account debit to his capital account to premium for goodwill. Compound entry we pass here, it will be easy and to save the time. On compound entry pass here, bank account debit 1,20,000 to his capital contributed 1 lakh and goodwill purposes 20,000. Therefore 1,20,000 debit side, credit side also 1,20,000. Now premium for goodwill distribution entry, second entry, that is premium for goodwill account debit 20,000 to his capital to this capital under sacrificing ratio. Here over it will be as a sacrificing ratio, over become SR because separate new not provided. The second entry for goodwill transferring entry. Now withdrawn of goodwill entry, that was his capital account debit, this capital account debit to cash or bank account. Half of the amount withdraw. So half of the amount here 16 half 8, 4,000 half 2. So this capital account debit 8,000, this capital account debit 2,000 to cash or bank account 10,000. Half of the amount withdrawn. General reserve, that is unrestricted profit, we know the entry general reserve account debit to old partners capital under old ratio 10,000 total general reserve, and it is under old ratio 4:1 coming 8,000 and 2,000. Now this is the that entry related to a little bit difficult entry, that is bad debt 1. So bad debt, when bad debt arises, bad debt account debit to debtors 2000, everyone knows that entry. Now already provision is sufficient, provision is there, so this bad debt we can transfer in our old provision. The second method we are applying here, so provision for bad debt account debit 2000 to bad debt transferring entry. Now after that, like here, we will calculate the new provision and we will compare with the old provision. Here old provision is getter rupees 640, so therefore like last entry, that is provision for bad debt, that is old provision for bad debt account debit to revaluation 640. That working is there, we can check the working here. Yes, gross data 36,000, old provision already 4,000. Now new bad debt 2,000 adjusted with old provision. After adjustment of the bad debt, remaining old provision is there 2,000. So after adjustment, we have the like old provision 2,000, old provision balance 2,000. Now new provision like gross data 36 minus bad debt 2,000, so 34,000, thereupon 4%, it is coming 13600. That is the new provision and that is the old provision. So old provision is greater than the new provision. How much amount greater? 640. So when old provision greater than the new provision, that time we can pass this entry, that is old provision for bad debt account debit to revaluation 640. If new provision greater, then reverse entry will have to pass. Now after that, decrease of asset, revaluation account debit to stock to furniture to machine, respective like asset value decreases, and we can pass the compound entry. Investment value increases, therefore investment account debit to revaluation 7,000. There is one unrecorded liability, so unrecorded liability increases, revaluation account debit to outstanding repair bill account 2300. Now after that, credit and debit will compare. So if we compare like roughly, in rough we can find out the profit or loss arises or not. So working for calculation, profit or loss on revaluation, debit side total coming 16,300, whereas credit side total coming 7640. Debit greater than the credit, it does mean the loss arises, loss on revaluation, and this amount is a loss on revaluation. So therefore loss on revaluation purposes, it will be transferred to all partners in their old ratio, and requisite entry here, sys capital account debit, this capital account debit to revaluation account. We know when that is loss, then like this entry will be there, partners capital account debit to revaluation. When profit, revaluation to partners capital. So when loss, it will be reverse entry, and that's their share of loss, distribution of loss. Without opening revaluation ledger as well as partners capital account, we can pass the journal entry, and with the help of rough working we can find out the profit and loss on revaluation. So that way this here problem came only journal entry. So as per instruction we should have to show the solution, therefore this is the solution for that year 2017. I think so it will be clear to each and every learner. I have to go through the details. Thank you, that much.